Hello, Internet. My name is ᴜsᴇғᴜ, and I am one of eToro's most copied popular investors. The other day, I made a video telling people not to be afraid of bear markets and also what the best behavior might be for the new investor when it does come to a bear market. I also promised that I would give a video explaining a little bit about how I would deal with a bear market or a correction. And so that's where we find ourselves today. All right, I've been around the block a few times and been through a few corrections, more than a few corrections, and bear markets. And so I feel as though I am better positioned to take advantage of these situations when they arise. All right, and without further ado, let's dig into it. Okay, first up, a few definitions. People quite often throw around the terms correction and bear markets, but actually there are not exactly formal, but well agreed definitions of pullback, correction, and bear market. So a pullback is usually when the market, and when I say the market, people are usually talking about an index, and quite often the S&P 500. So let's assume I'm talking about the S&P 500. So a pullback, why am I having such trouble saying that word? A pullback is when the market drops by somewhere between 5 and 9% fairly quickly, but also it's going to recover quite fast, a matter of days or weeks. A correction is larger than a pullback, so it's usually 10 to 19% of the market value is lost, and that can last from a few weeks to a few months, but it will come back. Investors, they'll be a little bit scared, but the market will come back fairly shortly afterwards. And then we have the big bad bear market, and a bear market is usually a drop of 20% or more, and it's characterized by investors becoming quite fearful, a loss of confidence in the market. People will withdraw their money from the market and they'll rush to safe havens and they'll sit there and wait it out until the worst is gone and some kind of recovery looks as though it's underway. All right, so keep those things in mind. Today I'll be talking about probably the bigger of those three scenarios, the correction and bear markets. My treatment of them would be fairly similar, and I won't be talking about pullbacks at all. All right, so before we talk about how I will do things, I wanted to also be quite clear about something. No investor will always be in profit. Most of the time when the markets are driven south, they will follow the market. And you should accept this to some degree. So the investors, maybe they will beat the market now and again. I know, for example, last year there were a number of investors on eToro's platform that did fantastically well and made no loss through the downturn through February and March. And I'm not diminishing their skill, but no one will be able to ride every downturn and come out the other side profitable every day, week, and month of the year. And you don't need to be. This is the lovely thing, is you don't actually need to be. And I wanted to demonstrate that today with some examples. So what I've done is I've created a theoretical situation. So my goal as an investor on eToro's platform is to beat the S&P 500 on average every year by 20%. And so I've taken the S&P's return from 1975 through to 2019, and I've just added 20% onto its return. So my imaginary return versus the S&P's real return since before I was born. And the reason I'm doing this is to emphasize the point, back it up with some numbers. And so this is a chart of, through those years, the S&P's return and my return. My return is always higher because, in theory, I'm beating it by 20% each year. And you'll notice that the S&P 500, it doesn't always make a profit. Sometimes it turns a tiny profit. Sometimes there's a loss. Sometimes there's a big loss. And so in this theoretical situation, if you were investing with me all along, there would have been 2 years in this period where you would have been in the red. In 2008, the financial crisis, you would have been in quite a lot of red. There are other times when the S&P 500 has performed very poorly, and my theoretical performance against that is also quite low. For the past 5-6 years on eToro, my returns, except for 2018, have been very high, but that doesn't necessarily mean that next year, 2025, my returns could be 1%. And I'm here to tell you why that is okay. So in this theoretical scenario, there will be some years where you would have been full of fear and very unhappy with the performance of the portfolio in that particular year. But if we looked at the cumulative gains across this period, and you had invested $10,000 right at the beginning in the S&P and also with me, your $10,000 would have become $471,000 in the S&P 500, which is excellent. I mean, how many years is this? 30, 35, 45 odd years, 44 years. And with me, your $10,000 would have become $1 billion. So that's a lot of money. And I, like other very successful investors, would be unlikely to create the outsized returns as the amount of money I have grows. So Warren Buffett, for example, he's known for saying if he just had to invest a few $1 million, his returns would be much higher than they were today. Similarly, ARK Invest, for those of you that follow ARK Invest, fantastic company. When they had $30 million in AUM some time ago, it was much easier for them to make money because moving smaller amounts of money through the market is much easier. There's less bureaucracy, and you can be a lot more nimble getting into and out of positions. When you have a few $100 million, billions of dollars, things become quite difficult because a lot more people will be watching you. There'll be a lot more rules about you moving money around in the market, and also taking a position becomes a lot more difficult. If you wanted to buy $100 million of a small or medium cap company, you will affect the price of that company in buying or selling your stock. And so you might need to time those buys or sells over a certain amount of time. So long story short, the more money you have, the more difficult it is to make big returns because there are a lot more rules and bureaucracy around that amount of money. But we're looking at a hypothetical situation. So why shouldn't we become billionaires in this scenario? So the long and short of it is, for any investor, you will have good years and you will have some bad years. You just want more good years than bad years. And because of the compounding of returns, you can make eye-watering amounts of money if you are patient over that period. Now, to bring it home a little bit, let's look at some real numbers. So instead of the yearly view, let's look at the months through last year. So 2020 was a highly volatile year. And if you had invested $10,000 in the S&P 500, these are the returns you would have made in percentages and in dollars. And so you can see my corresponding real returns. I'm not just adding 20% onto these. This is real S&P and real Wesley returns in the market. And you will notice that a lot of the time I am beating the S&P 500, but sometimes I don't. And you'll see in particular that the S&P 500 beat me in the worst month of the year, March. So if you'd been copying me from January through to March, you would have been carrying quite a lot of red by this point in time. But the thing is, I started preparing my portfolio for the likely outcome towards the end of the year within these months. And that cost me a little bit within these months, but it meant that my return through the rest of the year were fantastic. And so just mapping out the actual dollar returns, you can see that you would have been in red with both of us, the S&P 500 and myself. But if you had stuck it out and not sold, by the end of the year, your investment of $10,000 with me would have made more than a 50% return. Okay, so I had to set the expectation. I will probably follow the market in most instances when there is a correction or a bull market. And that's not necessarily the end of the world. Okay, So let's talk about the nitty-gritty. How will I deal with a correction or crash? I'm getting this question all the time, by the way. Investors are getting nervous. There's a huge rally. People have gotten very comfortable with seeing green in their portfolio day in, day out, week in, week out, month after month after month. And this is not the way the market usually works, by the way. You usually see a few red weeks in a month and a few red months in a year. So don't be too terrified about it. Now, on to the question, how would I deal with it? It depends on the kind of crash. Because the crash will have been caused by certain things within the economy or some kind of triggering event. So during the dot-com bubble, we had a number of very small businesses rising to incredible valuations, and everyone getting quite enthusiastic about how much money they could make. And then suddenly the rug was pulled out from under their feet, the wool removed from their eyes, and they realized we're buying nothing. And so the dot-com bubble collapsed. Now, dealing with that kind of collapse is very different from the 2008 financial collapse, where there was some, weird financial derivatives based on the mortgage market, and that in turn would have been very different from how you would have traded the global pandemic, the initial lockdown last year. And so, how you deal with crash correction, there are some common elements, but it depends on what was happening before the crash, what caused the crash, and what you think will happen next. Right, so in terms of my strategy in general, in the world of investing and trading, my strategy is, there are a few different names, but you'll hear people talk about a core and satellite. And so in the core of my portfolio are the businesses that I think will give double and triple digit returns over the next decade or more. I think that no matter what happens to the market, these companies are going to continue to be excellent companies. Their stock prices might fall and rise, but ultimately, over a long enough timeline, the returns will be fantastic. And then within the satellite of my portfolio, which is the smaller part of my portfolio, I have some riskier trades or other types of businesses or hedges. And these types of assets are usually more short-lived. So they're there to deal with whatever's happening in the market at a particular point in time. So when the tide does turn, and the tide always does turn, we don't know when, we don't know how deep or for how long. But let's talk specifically about what I expect to happen next, what will cause and what will happen in the next dip. So throughout 2020, there were a number of companies that were favored. Those are companies that, in general, were able to make money when people were either at home and not working or working from home. And some of those companies' values rose to incredible levels. They're at levels now that are well beyond what their fair values should be. And I expect that at some point this year, that trend will unwind to some degree. A lot of those companies are still good companies, but it's just that their stock price right now is higher than they deserve as a business. On the flip side of things, we have all the companies that did terribly from a world that was locked down, the travel companies, the hospitality companies, some of the construction and material industries. And so the money flowed out of those companies, and they have been very risky through the past year, so that's to be expected, and into the COVID winners. But there are still some very good businesses in those sectors too. Companies that were well run before the lockdown, that have a lot of cash on hand, or they have access to debt facilities, and they were really well run. And once the world is opened up again, they will do fantastically. So now we're in this halfway house. The coronavirus vaccines are being rolled out. We're still in the beginning of that process. There's still a lot of uncertainty as to when the world will start opening up and what opening up means. But somewhere in the next few months, a lot of that picture will solidify. Those plans will start becoming reality. And the stock market is a machine that tries to predict the future. So when it looks like the future 6 months out, 12 months out, is going to be a world that is opened up, I believe that investors will start looking at those stocks that they've been investing in for the past year that are very expensive, and they will say, these are actually quite risky. These are very expensive for the price that I've paid for them. And actually, there are a whole bunch of other industries and companies that are very good and are going to do very well through an opened up society. And they're less risky. And they're all quite cheap. And so we will see a massive movement of money from the COVID winners, the COVID winners, lockdown winners, into those industries. Now, a lot of those companies, the tech companies that have done well through the past year, are some of the biggest constituents of the S&P 500 and the Nasdaq. And so when their share prices drop, they will take the whole of those indexes with them. And the market is not the most rational place, as you may have noticed. And so companies that don't deserve to lose any value on their share price will also drop with everything else. But the more experienced investors, the institutional investors, they know that this is going to happen, and they will take that opportunity to start moving money from the overpriced areas into the cheaper areas. So I think we might see a fairly sharp dip, followed by a pretty sharp recovery. But the recovery in those indexes will be driven by different companies. Not all of tech is extremely overpriced, by the way. And a lot of those companies that have done well through the last year and are overpriced are still good companies. So I expect their share prices to rise over the coming years. But you'll hear people talk about a rotation of funds. And this is what I think it will happen. I don't know what will trigger it. I don't know how long it will last. I don't know how deep it will go. But I think it will happen. All right. So what would I do in this scenario? Well, I've already started doing it. Through the past, I would say, half a year, I've known that tech stocks are massively overpriced. Some tech stocks are overpriced. I've also known that would not stop. So I've not completely exited the tech market. And I still hold some of the assets that I think are incredibly overpriced because I know the market is irrational and it would probably continue to rise. But what I've also started to do is to buy companies in other geographies. So it's mostly the US tech market that is massively overpriced. There are other stocks in the US market that are overpriced too. But UK stocks, for example, have taken an absolute beating over the past few years because of Brexit and also our mismanagement of the lockdown overall. But there are still a number of fantastic companies in the UK. And so you would have seen me over the past few months buying companies in the UK, Europe, also China, who has been leading the return to normal, has a number of companies that they mirror the types of technology businesses and other businesses in the US. They haven't been ignored, but I think that they were considered quite risky because of the trade wars and other cold wars that have been going on between the US and China for some time now under the reign of Trump. And now, I would say in the past week or two, people are starting to pile into these types of stocks. So for the past 6 months, I've been buying different geographies, different industries. And to some degree, some of that rotation might have already started happening. And it's benefited my portfolio quite well through the past few weeks and months. All right, so I've started doing some of that. I've started building a cash position. So I've had upwards of 30% cash in the portfolio through the past 3 months or so. That's squeezed down to less than 10%, and I think it's back up to 20% now. So I will keep a lot of cash in hand. You will have noticed that I've been building quite a big VIX position, VXX. So this is a derivative, and it might actually be a derivative of a derivative. I'm not sure how many derivatives deep it goes, but effectively it's an instrument that has an inverse relationship with the S&P 500. So it's also called the fear index. When fear is high, the VIX rises, and when fear is low, the VIX falls. And so this is a bit of insurance that I've purchased. There's no fee to it, which is great, and I think that it will be engaged somewhere in the next weeks or months. Okay, so I've been doing stuff through the past few months. What about when the thing actually happens? Now, again, this depends on the trigger, and there are a few potential things that could trigger a mass rotation or a mass correction. One might be fears about inflation. You will have seen whispers of inflation, headlines about inflation across the media outlets. It might be that they just realize that some stocks are incredibly overvalued. It's very difficult to know what this trigger might be beforehand. So I don't know what it'll be, but something happens. When that does happen, I would decide which positions I should cut. And those depend on, to some degree, what the triggering event might be. Maybe I don't cut anything. But maybe I cut a whole bunch of positions, whether they're in a profit or loss. I decide which hedges to enforce. Do I start shorting indexes? Do I build more in my VIX positions? Do I decide to grow my cash position even more? But what I will probably do is keep a large portion of my core portfolio intact, because as I said before, I believe that those companies will continue to outperform over the next decade or two. And then at some point, it'll feel like things are slowing down. Potentially we found the bottom, or the sell-off is decelerating, the bear market is decelerating. I will start offloading my hedges, and those create cash for me, so they add to the cash position. And at that point, I expect it to be a whole bunch of new opportunities in the market. Many stocks, and I already have my list of I have a few lists of stocks that I would like to buy at fair valuations, and so I would begin buying them up. Not all at once, I'd buy them piecemeal, because we don't know if the market is going to continue to fall. And so I would cost average positions in assets that I think were fair value. And then I would wait, and I would wait, and I would wait. And at some point, the market will find its bottom and the market will start recovering. And if I haven't spent all of my money by that point, I would continue to average in to companies that were fair value. And then we would be A for away. When the recovery does come, the beginning of the recovery is usually where you see the biggest gains. And so you want to be in the market. You want to have as much of your cash deployed at that point in time so that you can catch that nice uplift. All right, so that's more or less the plan. And that's as much detail as I have until I know exactly what's going to cause the next correction or crash. I don't know when it's going to come. It could be tomorrow, it could be next month, it could be next year. But this is more or less how I would deal with it. I hope that has helped. If you have any questions, please let me know, and I'll do my best to get back to you. All right, cheers.